Hello, thank you so much for watching The Open. I'm Amber Canwar. We are less than half an hour away from the start of a brand new trading day. And what a difference NVIDIA has made in sentiment. Tech was a bit of a mess before NVIDIA rode to the rescue with a set of quarterly results that was really heard around the world. Not only did they beat expectations, but they signaled that growth can continue for the foreseeable future. That message was received by the markets. You had the S&P hit a fresh all-time high for the 12th time this year. We're not even fully 2 months in. Let's bring in Jack Manley, global market strategist at JP Morgan Asset Management. Jack, thank you so much for being with me. What do you think? Have we reached the point of irrational exuberance, or do we still have more partying to do?
Well, you know, Amber, when I think about this current market, particularly when we're thinking about the earnings season this week, we have to remember that we are talking about things that happened in the past, right? We are looking at 2023 corporate earnings, and we're getting a sense of what those earnings are look like now for a full year. And the story that's been told this week is a story that's been told for the better part of 2023, which is that the whales are at the table and they are holding all the chips. The profitability story in 2023 was very much a story of the haves and have-nots, those very small number of names, very large companies, tech adjacent, focused in on artificial intelligence, driving the overwhelming majority of earnings growth last year, while the rest of the index really sort of falling behind. So this doesn't surprise me a whole lot. But when we're looking out into 2024 earnings, I do think we have to think about a broadening out of the recovery here. You know, we're looking for maybe 6 to 8% earnings growth on the S&P 500 this year. We're thinking about half of that is coming from the non-Magnificent Seven or whatever you want to call them. So maybe a bit of a time for a breather as investors digest these much higher valuations in this very small pocket of the overall equity market.
I'm glad that you brought up the outlook for 2024. Against this backdrop of a market rally, what has been quietly happening is a rise in bond yields. You have seen struggles in certain areas of the markets. Once again, the regionals, that's not really capturing the same attention because, you know, the NVIDIA story, the tech story looms so large, to your point. What is the signal you're getting from that sell-off in the bond market, seeing the U.S. 10-year yield now around 4.3%? How should investors think about that part?
The dance that happens between bond yields and stock prices is always sort of a confusing one. And for a very long time, rates rising was a bad thing because it makes the cost of borrowing higher. And these growthier names need to be able to borrow at very low rates to fuel growth. But now the story, to your point, Amber, right, feels a little bit different because we have seen rates move up quite a bit relative to expectations even a few weeks ago. And yet here we are with the equity market busting through yet again into all-time highs. I think what we have to recognize here is that the reason that interest rates are moving higher is because the economy has been a whole lot better than a lot of people were giving it credit for. CPI and PPI last week in the States coming in better than expectations, but still part of this broader disinflationary trend that we've seen for the better part of the last 18 months or so. The labor market's still very, very strong. Consumption figures still relatively strong. What's happening in the interest rate space is that we are just delaying the timing of that first interest rate cut and the number of cuts that we are expecting to see this year. The market kind of course correcting, so to speak, relative to what it had been thinking at the start of 2024, coming more online with what the Fed itself had been telling us in December. I think that's why you're not seeing so much volatility that you might have otherwise expected. Rates are rising, but they're rising for the right reason.
And I want to ask about what that impact is to bond proxy sectors like real estate, like utilities, like telecom, because there was a temptation to look at the yields that you're getting, to look at the valuations and say, you know, this is incredibly rich and in some cases unprecedented. But if the economy is going to do well and rates might hold up a little bit more, how tempted are you to get into those sectors?
So I think, Amber, if the economy holds up well, then what you're going to be seeing out of fixed income markets this year is mostly a coupon-driven return. And you know what? That's not bad news when you consider where coupons are right now, significantly higher than they've been really in the last 2 decades. So your floor is not really too low. You're talking 4, 5, even 6%. In that environment, though, perhaps there is more room to run in those bond proxies because not only are you getting those healthy dividend yields, but you also get market participation. If, however, there is a recession this year in the United States, and to be very clear, that is not my base case, then what we are going to see happening is a lot of this increase in interest rates unwinding over the course of this year as the Federal Reserve embarks on some ultra-aggressive or at least aggressive cutting, right, to sort of stimulate growth, a lot more than what they had initially telegraphed. If that happens, then the duration trade kicks in alongside the coupon, and fixed income works a lot better than equities. So I think it has a whole lot to do with your macro view. I'm not looking for a recession this year, so I'd probably lean more into those bond proxies, but nothing wrong with fixed income in today's market, certainly.
That's interesting perspective. It sounds like you are advising your clients to take a more prudent approach. Don't go all in on the tech sector. Diversification is key, but to remain invested. You know, maybe this is not the time to be sitting on a pile of cash.
That is absolutely correct. Yeah, I mean, that's exactly how I would think about it. You know, to be clear, I am a long-term tech bull. I'm a long-term growth bull. When I think about technology, I think about all the changes, the innovation that is happening. No one is going to be able to tell you that tech's going to be less important in 10 years than it is right now, right? This is a long-term secular trend. So it's not about abandoning those winners of the last couple of years. It is, exactly to your point, Amber, about broadening out the opportunity set and recognizing that there are another 490 names out there in just the S&P 500 that haven't really done a whole lot of anything over the last 13 months or so. They're trading at much more reasonable valuations. They're actually punching above their weight class from an earnings contribution perspective. It's a good time to step out of cash and take advantage of those emerging opportunities. And it's important to take advantage of those opportunities with active management and security selection. That's how we're thinking about the equity market today.
Jack,